Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now, I'm pleased to say, Brian Moynihan, CEO and Chairman of Bank of America. Brian, we have to say thank you. Thank you for having us.
Oh, it's great for you to be here. These talented teammates are out working early in the morning and hopefully making some money for the shareholders.
It's getting noisy. We could talk about how much money they're making in just a moment. I actually wanted to start with a quote from Liz from the Bank of America Institute in the first hour of our coverage here. I find this stunning every time I read it. This will be the fifth time already today. Median value of savings and checking balances are more than 40% higher than 2019 for all income levels. As you look across the business, consumers, companies, just how resilient is this economy still?
Well, Liz and the team do a great job of putting this out, and we purposely created the Institute so we could get this data out. And it's not a reflection of what's coming tomorrow. It's more a reflection on what you see in the past. But it's very granular, 60-plus million customers, 37 million checking account holders, and they have been remarkably resilient. And so the idea, if we were sitting here last year, this time we'd be talking about our team was predicting a recession somewhere early this year. It didn't. Then they took that off the table as we moved through the year, and now they're predicting 2% plus growth for this quarter. So you've gone from negative to slightly positive 2%. That is returning to the mean. It's not outsized growth. It's actually slowing down. So people can't forget we're going from a 4 to 5% growth rate to 2.5% growth rate is slowing down, and the restriction on the economy accomplishing its purpose. Meanwhile, the consumer is very resilient, and that's providing an anchor to windward that the Fed has latitude that a lot of places don't have, that they can hold the restrictive and let the economy really catch up. But they have to be mindful of the change. At some point, that consumer will slow down, and they have slowed down their spending. And so last year it had been 10% growth. This year, in the fall, 5%. Now it's down to 3 to 4%. They've got to be careful they don't overshoot. So this is the tension we're in right now, which is this resilient economy, and actually, as you said, Lisa, actually trying to bring inflation down. Since the financial crisis to now, most central banks are trying to get inflation up. And so it's a completely different execution, and that's what we got to get right.
You're dominant in small business lending. Yeah. I'm just wondering just how much confidence there is out there still in corporate America at the lower level, in the small companies across this country.
If you say by virtue of their activity, it's strong. But on the other hand, line usage, and Wendy will be on here later, she'll talk about that. Line usage has come down a bit, which means that the cost of borrowing went up, and so therefore I'm a little more careful. And so hiring's a little more careful. Equipment purchase, a little more careful. And so, well, they're fine making money, and the profits are strong, and the team will talk about profits driving this market, and the EPS estimates for public companies. Even mid-sized companies are participating in that. The American economy is the dominant economy in the world right now in terms of activity and interest and investment, and lots of good trends for it. But on the other hand, why aren't they using our line so much? It's a little more costly, therefore you're a little more careful. And that's the tension we're going through. Everybody's trying to really figure out how this economy will perform. And 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not. But now the question is, do they really want to invest heavily in it? And that's where you're seeing a little bit of tension here. So everything's fine, solid, resilient, all the words you wanted to, but it has to sort of work the next twist in the economy to get back to normal.
It's funny. I hear some of the people who work for you, and they sound incredibly bullish. Nothing's wrong, whatever. Is it your job to basically look around corners and see what potentially could be the problem, but otherwise things are screaming, and it suggests that even 4.5% 10-year rates would be just fine for the lending and the activity that you're seeing?
Well, I think we're also adjusting as a company and as an industry and as a society to a simple thing that from 2007 or 8 till 17, you had no interest rate. Then you had interest rate for about 24 to 36 months. Then they were dropping rates in 2019. Then the COVID comes and they drop. So we've never really had a normal interest rate environment. What would have typically been a 3% front end rate, 4 to 4.5% back end rate, a normal sloping curve, real interest rate. It hasn't occurred for anybody under 40. They literally weren't working back then. So, that sounds curmudgeonly, but the reality is that's true. So everybody's adjusting this. So these high rates at 4.5% in the 10-year are not high rates in the grand scheme of things. They're high rates in the last 15 years. So we got to adjust to that, and that'll take time to work through the systems and models and thought process. Our team is the best team in the world in research, and you're going to hear from a lot of them today, and your viewers will benefit. On the other hand, as you look at it more broadly, my job and the team's job at the top of the house is to make sure we're balanced for all outcomes, and that's why we're always worried about what happens tomorrow, and we plan for it.
The balance in outcomes is leading to some really frustrated and bored traders, and we talk about that with a lot of people who basically say there's not a lot to do because you can't really get an edge. Are you seeing that in trading activity? Are you seeing that in trading revenues as people basically have no incentive other than just to hold NVIDIA, hold on to, some of the credit that keeps on rallying and just, make bank?
Well, our team has just come off of last year a record amount of revenues in the quarters, a record in growing quarter over quarter, and we think they're going to fare well this quarter. We told the market that a few weeks ago. And so Jimmy, DeMar, and the team that's out here, the research team under Candace and the investment banking team under Matthew, are driving the business and actually gaining share. And so while pools are down in investment banking, we've gained some share there. While pools are stable, flattish, we're actually up, and that's different in this business. And they do it with the right risk. They made money, I think, every trading day last year, nearly every trading day for the last 5 years. And so they do it the right way. Is that boring or not? You have to ask them. It's just fine with us because at the end of the day, that recurring capability, that ability to keep delivering for clients and doing what they need to do and make money at it and deliver for the shareholders and get a return on capital is what Jim and the team have done a great job.
You alluded to it. Have you maintained that momentum from that record fourth quarter?
Yeah, we think we're this quarter start off well. The team's doing a good job, and when you get to be bigger and bigger, it's hard to keep that growth going. They keep doing it.
Can we talk about the M&A slump as well? Are we working our way out of that? We wake up every single morning, we've got a new big blockbuster deal, and then we have a conversation about whether they can actually close it or not because of antitrust concerns down in Washington, D.C. Do you find us exiting that slump this year? Is that what you're looking for?
I think until there's a clarity on policy, that question is going to come up every time a deal is announced. So the companies are actively engaged in a dialogue, trying to figure out the strategic moves, and then the question is, can they get the deals through? And that happens in all industries. We need to get this resolved. We need to get to a more rational, predictive outcome to have people willing to take the risk of putting their company at risk for a sell side, and that's really what it comes down to. The buyers, put themselves somewhat at risk. The sellers really put themselves at risk because a company, hanging in abeyance for a longer period of time is a tough place to be. Having been there before in my life and having caused people to be there a lot in my life, it's a tough place. And so how to run the company, what you can do. So I think we need to get a faster turnaround. The idea is these transactions don't change this month or a year from now. They're the same transaction. People need to get after them, look at them, decide what they're going to do, and give clarity so that the market can take place. The good news is, investment banking revenues have stabilized and moved back up, and that's good. But the M&A piece is still the piece that could come on and push through.
Do you find that some clients are reluctant to make deals based on what you just
100%.
said? Even though they make business sense, they just don't even want to entertain the conversation?
Because the risk-reward balance is so tough. Not everybody has the staying power to fight through, lawsuits and time and effort and things like that. And so it really requires if you said you needed 10 points of strategic import out of 10 to do it 10 possible points, you might need 7 before. Now you need all 10 because you really have to say this is worth hanging on to and fighting through. That's a different environment. Now, against that, you are seeing deals announced, and that's because they make strategic compelling sense for that buyer, seller, et cetera. But it's just been slowing things down, and I think as there gets a rationality here and around the world, because remember, none of these deals are simple anymore. For any company, they have operations in Europe where there's same sets of approvals or different sets of approvals and operations in other environments. But at the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
So let's just talk about some of the policy shifts, which is a nice, gentle allusion to the election later on. Potentially they could offer some more certainty. What kind of M&A boom could you see after that certainty has been established?
We'll see. I mean, I think, elections are elections. This company, the oldest part, has been around since 1784. And, there's been a lot of elections since that time frame. And, we have to adjust. People, I think you guys asked me in Davos, do you have a drawer for one outcome, a drawer for... The answer is no. We just run the company and drive it. So, I think certainly around the election process here and around the world, we'll add to, okay, we know what we're dealing with and go on. And so that'll create some energy. But I think we have to be careful to say one thing leans one way, one thing continuing late. Because, frankly, the politicians have to get this right for the good of their own state economy, country economies and stuff, and I think they're all struggling with it.
So we talk to a lot of strategists, political policy strategists, and they all say no one can really quite believe that it's Trump versus Biden again. And so they're trying to figure out who it's really going to be. Is it going to be you?
Me what?
Running for office. I mean, this is sort of what people are talking about. They're talking about Jimmy. I mean, this is sort of something that comes up in your discussions.
I've got a great job here.
I had a feeling you wouldn't put your hand up to be Treasury Secretary in front of the team this morning.
I know, right? You want to make sure
I've got a great job. At the end of the day, our job, my colleagues that are in the leadership across all industries, is to help any administration be successful, and that's what we try to do here and around the world. And and those are tough jobs, and but I don't think I'm running for office, so I think I've got a great job here, and I've got to continue to do it and try to help this team and everybody be better than we could be tomorrow than we are today.
There's been some fires to put out over the last 12 months in the industry. It's been a year since SVB failed. NYCB has been a new issue. Seems like last year was a rate shock, and this year just big worries about maybe a credit shock. Have you noticed any deposit flight coming towards you from regional banks in any way, shape or form similar to what we saw 12 months ago?
There hasn't been the kind of change there was last year because there are unique business models. That's what's not involved. A little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows, and we don't see it anywhere. The industry is well capitalized, has good liquidity. Believe me, from last year to this year, people short up their liquidity across the industry. Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession, and so there'll be difficulties, and we're working that. But the trading attitude, which is these assets got to move at a price tomorrow morning, isn't the way the banking system works. And frankly, that's the value of the banking system. We work with clients. We figure out what you take a building, you figure out what the ultimate end state rental rolls will provide. You refinance it. Sometimes that wipes out the equity. Sometimes it doesn't. We're careful in how we underwrite as an industry. The top 30 banks go through the stress test, which has an effect that says, wait a second, if you're underwriting out in an odd way, you have to put up the capital to prove you're right before you even get the chance to prove you're right. So in other words, your capital requirements reflect your underwriting today, even though recession may never come. And it reflects your underwriting commitments under a scenario where commercial real estate drops by 30 or 40% instantaneously. So there's an effect on that on the industry, which is much more conservative building and much more middle-of-the-road building, which is probably slow down the capital provision to some of these companies, but on the other hand, it's not a bad thing when you get to this point. So we feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
When we caught up in Switzerland, we were talking about the prospect of a change in capital reserve rules. Chairman Powell in his semi-annual testimony appeared to back away from that. What was your reaction to what Chairman Powell had to say in the last couple of weeks?
Well, we in the industry and we at Bank of America believe that we have tremendous amounts of capital, liquidity. It's tested, the stress test. We don't need to keep moving the rules around. We're clear about that. And so, I think as people look at this, they're saying sort of what's the reason? In the end of the day, U.S. banking system and the U.S. economy are coexist with each other, and the U.S. economy has grown from pre-financial crisis now. The European economy has grown a lot less. The U.S. economy is much more vibrant. It's recovered from the pandemic shock faster. It's absorbed some of the things. And everybody says, well, that's because X, Y, or Z. But the reality is it's because the kind of capitalism practice in the country is good, and the kind of banking system, financial system more broadly, helps that happen. And so, we've weathered storms. Just think since early 2000, we've had a pandemic, recovery from the pandemic, the fastest rise in interest rates, 2 kinetic wars on the ground, trade debates around the world, shipping restrictions. You go through all this. In the end of the day, this industry, we made $100 billion after tax from 2020 through now. And we built huge reserves, we took them back, we dealt with the pandemic, $70 billion of borrowing overnight, a flood of deposits, some of those deposits come out. That's the resilience of the system, and that's why we got to be careful about adding capital and stuff when the perceived risk we don't think justifies it.
In the meantime, there has been a shift in terms of consolidation of market share in some of the bigger players. And you were talking about how you were gaining market share. Who are you mostly gaining market share from? Is it the smaller banks? Is it from Europe? Where in particular?
Each of our businesses, our 8 lines of business, have different places they gain from. And so when it's the investment banking and with Matthew Coder and the trading team under Jimmy, that's largely coming from the long tail people. This business is hard. It requires about $1 billion of technology investment a year to have a trading platform to keep up with it. So think about that.
Wow.
So when it's that hard, that means people who don't get the returns on capital have quit, and it's come this way. That's very different from the consumer bank, where Dean Athanasia and Holly O'Neill and Aaron Levine that run that business for us have just been driving core account growth. And so, well, they give you the statistics about constant accounts. We've grown our consumer base probably 4 million core checking accounts since the pandemic. So the deposits are up because of those extra balances. That's coming from everywhere. So it really comes from different places, but the idea is our job is to win the market and take it from every place.
When you talk about the investment in technology, how much is that going to be an ongoing benefit to a bank like yours that can invest in some of the artificial intelligence that we're hearing about every day?
So I think if you think about, we got to be careful about artificial intelligence versus machine learning versus digitization versus digital practice, because it's all different things. But let me just give the simple stats. In 2010, we had 100,000 people in our consumer business. Today, we have 60. We had 6,000 branches at the high point about 2008. We have about 4,000 now. We had about 400 billion deposits. Now we have 900 billion. The amount of transactions going through is light years bigger, and we're doing it with 40,000 less people. And the expense base we run the whole company on today, nominal expenses of $64 billion, round numbers, is the same we ran it on 2015. That is all the stuff you're talking about. That's applying technology over and over and over again. And are we perfect? Absolutely not. Do we have room to keep applying? Yes. Is there plenty ahead of us? It's unbelievable. And so if you look ahead, we're basically running on neutral headcount. And everybody says, well, you're not hiring. We're hiring people in businesses and putting revenue generation capabilities out there. At the same time, we're taking it out of the expense base. And that's a constant strain. And it's pretty remarkable what you can do. But if there was some way you snap your fingers and change the whole thing, you would have done it. I mean, we're not.
What you just said, though, is so important. And can we finish there? I was going to jokingly ask you whether we'll all be replaced by a big supercomputer in the next 5 to 10 years. And I think a lot of the people behind us would like to know the answer to that question as well. But I guess effectively in the next 5 to 10 years, are we effectively saying that each additional dollar of revenue is going to be less and less labor intensive because of this adoption of technology?
We had 300,000 people. We have 212,000 today. It's going to have less labor content. Are those people paid more? A lot more, because the way the labor content shifts. And so if you think about it, it will have less labor content because that is the expensive part, but it'll have more value added from labor because that's the way the mathematics will work. And so as you think about these trends, they're inexorable. They just keep going on. But people are forgetting these trends are already going on. And so one person's AI is another person's algorithm models that traders have been using for years. One person's AI is another person's Erica, which is 18 million customers using it every day type thing. And so you got to be careful about it. Is there potential here that we've never seen before? 110%. But the real question is, you don't have to wait for that potential. You're taking it out every day if you're working at it.
No 3-day week coming to Bank of America anytime soon? Is it Jamie who said that? 3-day week?
I'm not sure I understand the math there, but our team does a good job. They want to work 5 days.
I'm sure they do. They're nodding away. Yep. Brian, it's good to see you. Thanks for having us. We appreciate it. Brian Moynihan there, the chairman and CEO of Bank of America. Bank of America, Savita Subramanian, head of US equity strategy, and Jill Carey-Hall, the head of US small and mid-cap strategy, saying this: we raise our S&P 500 year-end price target of 5,400 from 5K, but our bullish conviction has cooled since publishing our 24 outlook in November. We expect the market to broaden beyond the Mag 7 and pockets of the market where we have seen more euphoria. The net message of our market timing framework is still, in one word, up. Savita and Jill join us now for more. Thank you very much for being with us.
Thanks for having us.
Thank you for having us.
Very exciting. I think this is our first time on TV together, so I'm very excited.
Well, let's talk about the constructiveness you both share. And Savita, let's begin with you. That word euphoria.
Yeah.
Where are you seeing euphoria right now?
Look,
and where aren't you seeing it?
I think euphoria is really driven by themes at this point. So it's AI. Everybody owns the AI plays. If you look at positioning, there's a lot of building euphoria around drug drug discovery, GLP-1. So there's thematic euphoria. But if you look at the actual allocation of fund managers, pension funds are at the lowest level of equity exposure, public equity exposure, that we've seen since the 90s. This is not a market like 99 where everybody is telling you to back up the truck on all equities. They're saying back up the truck on a few equities, mega cap tech, some pharma, but there's no broad spread euphoria in my view. And when you look at the positioning, it says something a little bit different than the survey data, which I think is also important. What they say versus what they do is sometimes very different. I think the risks are sitting outside of the public market. Look at where this credit cycle actually unfolded. It was in private credit, private equity. And I think those are the areas. Regional banks, I think, are still working out some of their problems, and Jill can speak to that as well. But I think that's where you're seeing the credit issues really bubble up.
Jill, let's turn to the banks. How concerned should we be? It feels like we've moved beyond what happened last year. Is that still a focus for you?
Yeah, certainly. I think the regional banks are still an area where I think it makes sense to be very selective. We're positive on small caps this year, but within financials, that's an area where, larger banks have looked a bit better than smaller banks. But I think there's still opportunity in some of the regionals. I think this is a market where stock picking makes sense. Our analysts have done a lot of work here. I think the environment this year has gotten a bit more optimistic for banks, given everyone was expecting a recession going into this year, and now we're not expecting a recession. Our economists will talk about that. I think the backdrop for M&A could pick up if we see, potentially an easier regulatory environment. We'll see how the election goes. And I think commercial real estate is still an issue, but it makes sense to, again, be selective, be a stock picker this year. And that's an environment where there's a lot of alpha opportunity.
To Savita's point, Jill, does that mean it's all priced in, all of those credit issues that we basically have heard?
I don't think it's all priced in. I think in pockets of the market, especially when you look at the broader backdrop within, small caps, credit sensitivity, refinancing risk, there's a lot of issues that if rates continue to move higher or stay high, these are areas that are a lot more credit sensitive, and we could see areas like real estate that maybe multiples haven't moved as much. For the overall market, I think for small caps, they have largely priced in some of the credit risks. They were pricing in a recession. They were pricing in, a manufacturing recession. They were pricing in tighter credit standards. I think we're in a backdrop where if these continue to ease, then there's a lot more upside in that segment of the market.
Which is the reason why, Savita, it's so fascinating to hear you talk about how it's not a back the truck up kind of moment like it was in 1999 for all stocks, just some stocks.
Some stocks.
But it sounds like you might want to keep backing up the truck in those stocks because they're not as susceptible to rates remaining high.
Well,
they're not as susceptible to people getting cold feet and realizing that, oh yeah, there is some weakness in certain pockets.
Yeah, no, I think it's fair. And look, I see large caps as safer until we start to see the Fed really cut interest rates, because where we are now is an environment where we're pricing in, what is it now, three or four rate cut hikes,
2 or 3 now.
3 rate cuts this year, and if we don't get them, I think that's the risk for some of these more credit sensitive areas like real estate, like small caps writ large. I still think there's a lot of smaller companies that are economically sensitive that could do well in this environment. And then the thing I like about the S&P 500 is that a lot of the really risky stuff drifted down in market cap. So you're starting to see the S&P almost get higher quality by attrition since 2022 when the Fed started cutting rates. So if you look at CRE exposure, commercial real estate exposure of the large cap banks, it's a tiny sliver versus where we see it elsewhere. When I think about what you were saying earlier about, this policy having given the private sector, consumers and corporates, a long runway of making money on their short duration asset base and locking in long duration liabilities, I think that is what we're seeing in the S&P 500, in the average U.S. consumer, and those are the areas where I think we can press this, because even if the Fed doesn't cut interest rates, there's still, relative health and relative gains in those cohorts.
That's what I wanted to get into. Why do you think we have been so comfortable with this repricing of interest rates higher? Why do you think we've been so comfortable with hot CPI prints, hot PPI prints? Last week, CPI came in hot. The equity market rallied.
Yes.
What's that about?
Well, the S&P rallied, and parts of the S&P rallied because I think that the S&P 500 is now, a different animal than what it was in 2007. Half of it is asset light. It's got positive net cash in the biggest sectors of tech. So I think it's a very different credit cycle. And this is what we need to pay attention to is where has credit been extended, who borrowed, and who's going to be hurt by a rising interest rate cycle. We're starting to see that, but I think that's what unfolds over the next few years.
Leadership has been narrow. I think we can all agree on that, particularly last year. You make the point, Jill, and I think it's a point worth exploring, that small caps tend to outperform following periods of narrow leadership. What is that about? Is that connected to the cycle? What is that trend?
Well, I think, we've seen it both small caps tend to outperform and as Savita, and we expect, the equal weighted S&P 500, we see opportunities there as well. I think, we're in an environment where the market was led by these very narrow themes, some of these mega cap growth stocks. And now you're at a point where positioning is starting to turn more positive on economically sensitive themes. We've seen inflows into small caps for the last several months, but positioning is very light. A lot of these things run in cycles. So small versus large cap leadership, these longer cycles tend to last about 10 years. Investors were in a period from 2013 to 2020 when small caps underperformed. And now the average multi-cap manager is about 40% underweight small caps in their portfolio. So, I think this is a point where you're starting to see more interest in the theme. The economic data, some of the macro indicators that Candace talked about earlier are all turning off the bottom, so that tends to be a positive environment for some of these areas of the market that your average fund manager is underexposed to, like small caps, like cyclicals.
It sounds pretty bullish. I mean, yes, there's some risks if the Fed does keep rates here.
I think it's meant
for a
to
long
sound
time.
bullish. I think that's the objective.
I guess here's my question. It's not necessarily the same kind of conviction that you used to have. Why?
Well, I can answer that. I think for me, it's because there is more high conviction bullishness on equities. Like I said, not all equities, but pockets. And I think those are the areas you want to watch. I mean, how much do these AI plays have to beat earnings from here in order to continue to go up? So that's where I worry. And I really firmly believe we could see a correction in those areas of the market. We could see a 5% pullback in the S&P, which has been, the straight up benchmark for the last, almost 20 years now. But I think that those are the risks. I think outside of these themes, there's a lot of, dry powder for real growth. And when you listen to the Institute, when you listen to Candace talk about the indicators we all track, it sounds like this is more of a GDP story rather than just an earnings story.
Which raises this question, in a GDP story, don't bigger companies have an advantage structurally at a time where if they can invest in technology and they can invest in some of these small near-term investments, even as they lock in their longer-term obligations, Jill, ultimately don't you get smaller companies fundamentally disadvantaged in a new way that's different from in the past?
Well, I think while there's some of that, I also think that if we're in a CapEx cycle, a lot of the domestic smaller companies are the ones that benefit if, a large mega cap is spending. The domestic SMID cap, especially if some of these companies are reshoring, bringing back manufacturing to the U.S., I think that's a longer-term theme that'll benefit some of these cyclical domestic smaller companies within the U.S.
Final question, Savita. We often do this. I always ask you this. Biggest risk, still upside risk?
To the S&P?
Yeah.
Yeah, I would say so.
Savita, great to see you. Jill, thank you to both of you. I can't believe you've never done this together.
I know.
But it worked beautifully.
Yeah,
thank you.
for coming.
Do it again.
Thank you very much. Thanks for having me. Joining us around the table, Michael Gapen, the Bank of America Global Research Head of US Economics, alongside his colleague, Aditya Bhave, Senior US Economist. Mike, Aditya, great to see you both.
Thanks for coming to One Bryant Park.
Thank you very much for having us. Thank you once again. Before we get to the Federal Reserve, can we just talk about the recent economic data? And can you point to something that demonstrates we are sufficiently restrictive at the Federal Reserve?
It's tough. I mean, as Mike was just saying, housing is your typical suspect, and it's hard to... Housing did react. Activity did slow down, but maybe not for the reasons one would expect. I think you could point to bank loan growth as another area that's responded to higher rates. But outside of maybe loan growth and housing, it's difficult, in my view, to find sectors of the economy that had obvious interest rate effects.
Aditya, are the long and variable lags just super long, or are we just not tight enough?
Well, we are starting to see some impact on retail sales as well. The last couple of prints have been soft, and then what was more notable for me was the downward revisions. So after those revisions, it really looks like about 4 of the last 5 months on retail sales were somewhat weak. So we're seeing some moderation there. So far, it's being offset by very strong services consumption, but we'll have to see if that continues.
All right, I have to say, we've spoken to one person after another. Everyone's been bullish this morning. Looking at the consumer, yeah, retail sales might have been a little bit softer, but for the most part, right, it was, cash really good. Then the economists come in, and you guys say, well, there's a little bit of weakness. Is that enough, Aditya, that sort of around, we had one bad retail sales print, that otherwise people are being more discretionary? Does that really suggest we're sufficiently restrictive?
It's a good question. I think it's, as Mike said, it's tough. It's a question of supply and demand. Right, what we experienced in 2023 was a very broad supply shock from the labor market, from supply chains healing, and just by definition, when you get a positive supply shock, you're going to get above trend growth and disinflation at the same time. Right, the question is, where do we stand on that? And if those supply shocks go away, then I think we'll get a clearer picture of what's happening with demand under the hood. Some of the work we've done suggests that demand is cooling off a little bit, but there's more ways to go.
Is this enough, Mike, to give the Fed confidence that there's some kind of true disinflationary trend other than just year-over-year comps that were nice for a couple of months?
Yeah, I think that the premise to your question, I think, is saying is, does the Fed actually need to do more to bring inflation down, or is supply enough, right? So in other words, do we need restrictive policy to get sustainably to 2%? Because I think most people would say policy is moderately restrictive. It's doing something, but there's a question how much. But they're complementing that by saying, well, we're getting this helpful boost in supply, and that's also what's bringing inflation down. The combination of the two, I think, gives them confidence about the overall disinflation trend. So rates at some point should move lower. The lack of confidence is about when does the window open, when does the data tell them, okay, it's fine to start. So I think there's a little uncertainty about when to start, but I think the confidence in the overall disinflation trend is there.
So your call now is June. So let's talk about June. What is special about June, apart from the fact it's not March? But what is special about that month? Why is that the month now for so many people on Wall Street?
I'd say 2 reasons. The data aligns a little better in June in terms of year-on-year rates of inflation being, we think, at subjective levels that they might
move the goalpost here, though, Mike? Are they going to focus on year-over-year and not the month-over-month surprises?
Year-over-year is kind of, they've said we had a good 6-month run, we need more evidence. So I think that's kind of shifted us all to looking more a little to year-on-year. The other reason I would say June as opposed to May or July is that if you think you're cutting rates every other meeting once you start, I think you want to align those policy decisions on meetings where you release new projections. So I think that puts all of us on June as opposed to, say, May or July.
Let's build on that word confidence. The chairman talked about needing more confidence. Do you think, based on the evidence that we've seen, the data we've had between the last meeting and the one we're about to see tomorrow, that this chairman has lost, gained, or retained confidence?
I would say less confidence around the timing, but still confidence on the overall disinflationary trend.
You could sense, Aditya, in that news conference the last time around, he wasn't quite comfortable talking about the overall disinflationary trend. Yep. And he wanted to know whether any of it was due to one-off factors. When you look at the trend for goods inflation, do you think maybe that worry is justified?
So we got 1 month of goods inflation after several months of outright deflation, so I wouldn't say that's a concern yet. There's a couple of things, if you want to be concerned, that you could be concerned about. One of them is... Okay, well then let's give you something to be concerned about, right? One of the things is there was this question, if you just do it from a bottom-up perspective, about whether goods deflation would end or slow down before housing started to cool off. And it looks like that might be the case. Again, it's 1 month of data. You don't want to take it too seriously, but that suggests that you could get stuck above 2% for a longer period of time. That being said, the other concern out of the January report was that there was this big jump in services ex housing, right? Would that continue, or was that a one-off? And that actually looks like it was more of a one-off.
There is also this question that we keep raising again and again. Are financial conditions contributing to a prolonged inflation kind of sticking in the economy? And Michael, I'd ask this of you. Do you think it's important for the Fed to push back a little bit and say, yeah, if things get this easy, if anyone can borrow, if stock markets are doing great, if you see mortgages start to come back to the fore, if you just get a 0.5 percentage point drop in the rate, do they need to do that to kind of bring this sort of a little bit more in check?
I think they need to keep financial conditions restrictive. I do. I think things rallied too much from their perspective from the October-November period to earlier this year. I think they know if we're going to start an easing cycle at some point, financial conditions are going to ease, right? So they can't, have their cake and eat it too. But I do think they need to keep financial conditions restrictive on average. And I think they are. I think by our proprietary indicators, they're restrictive, but they're not as restrictive as they were in prior cycle peaks. But again, if they're getting a supply side rebound, that should be enough. But I think to your point, they would want to lean against, in their mind, whatever is excessive easing in financial conditions.
Aditya, how is this restrictive?
That's a good question.
Get all the hard questions.
Right. So what I would say is the Fed would be way more concerned if the markets aren't pricing an amount of cuts that the Fed views as appropriate, right? That was the case earlier this year, at the start of the year, when the markets were pricing 6.5 cuts, and that was clearly not what the Fed had in mind. Once the market's pricing a sort of reasonable number of cuts, let's say 3 this year or 2.5, then whatever that implies for equities, spreads, I don't think they want to get involved in that, right? They don't want to be in the business of managing risk premia. So I think they're reasonably comfortable now. They probably weren't at the start of the year, which is why the pushback was a lot more aggressive at the start of the year.
Let's finish on the playbook for tomorrow. So statement, projections, news conference. Let's go to the second point, projections. Only takes a few policymakers to come up just a little bit. That median drop's going from 3 to 2. Aditya, is that what you're expecting tomorrow?
No, we're expecting them to stay at 3 cuts, the median 2, but it's a very close call. As you said, it only takes 2 people to move up in order for the Fed to go from 3 to 2 cuts. The question is, do you really want to signal that? What are the implications of that? Just to add to a point that Mike was making earlier, if you can't justify a cut by June, given that the base effects will be a lot less favorable for the rest of the year, you might not have a leg to stand on to start cutting until early next year. So that might be a reason to just get going now unless you're really comfortable starting next March, right? So for all of those reasons, we think it stays at 3, but it's going to be a very close call, and that's going to be the big focus for markets.
Mike, what would you look for?
So we're on the same page for that. But yeah, it's a close call. I think you're going to get a big upward revision in growth. Something maybe to around 1.8 this year. We think PCE inflation on a core basis gets revised to 2.5, 2.6. We're at 2.6. We think there's enough time between now and June for them to say, let's look at the data a little bit more and not prejudge it. But yeah, it's a close call.
Can I just say, they don't care about spreads and micromanaging them when they're doing well, but they care when they're doing badly. So it raises this question, ultimately, we're talking about a Fed put all over again,
Do you want them to be consistent? Is that what you're asking for?
I'm just looking for some sort of
I think we're trying to figure out how symmetrical this actually is right now.
Thank you.
I think there is a belief in the market. There is an asymmetric stance at the Federal Reserve that if growth is strong, they won't respond to it with hikes. If it's weak, they can cut. I think what we're trying to figure out, at least from myself over the last week or so, with hotter than expected inflation prints, whether that tempers their ability to retain that option of just saying, we'll cut if the economy weakens, we won't hike if it gets stronger.
Right. And I would add on top of that asymmetry, remember in average inflation targeting, you're only responding to shortfalls of employment from its maximum level. So another reason to kind of ignore what's happening on the activity side.
And just on that subject, we get asked a bit about the downside risks, right? And I think the big downside risk is probably if you can't cut this year, you get to next year, inflation's still sticky, things slow down and you don't have the Fed put, right? So we've been so reliant on the Fed put that the big downside risk to the economy is if that goes away, things could get sticky.
What do you think they would do, Mike? Can we finish on that? I want to give you the final word. If the dual mandate went into conflict, how this Federal Reserve, led by Chairman Powell, would handle it? How do you think he would handle it?
So in what sense would it be in conflict?
In conflict, if inflation was still above target, but unemployment started rising and it threatened maximum employment?
Ultimately, I think they'd respond to the activity side, because I think you would assume inflation with a lag would ultimately respond to that economic.
Would that be the right assumption?
Yes, I think so.
Okay.
Yeah.
Mike, appreciate it. Michael Gapen.
Kind of a weak last word there, but thank you.
No. Don't worry. The conversation will continue from Bank of America, the two of you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.